Today, we're diving into the economics of business strategy, a crucial area for understanding market dynamics and firm behavior. This involves navigating key decisions to achieve competitive advantage and ensure long-term profitability in dynamic markets. Let's explore the foundations of strategic interaction, which provides a framework for analyzing how firms compete. We'll be understanding the core elements of game theory, a powerful tool for strategic decision-making. First, we have players, who are the key decision-makers in any strategic interaction or game. These are the decision-makers whose actions directly influence the outcome for everyone involved in the game. Next, we define strategies, which are the available courses of action each player can choose. This refers to the complete set of possible actions or choices that each player can make during the game. Then come payoffs, representing the rewards or costs associated with each possible outcome. These are the outcomes or returns each player receives, directly resulting from their chosen strategies. Finally, we consider equilibrium, a stable state where no one benefits from changing their mind. This is a stable state where no player benefits by unilaterally changing their strategy, given others' choices. Now, let's look at game dynamics in business and how they play out in real-world scenarios. We'll examine how timing and repetition significantly shape strategic decisions and their overall impact. First, we have simultaneous games, where all players act without knowing their rivals' choices. In these games, players make decisions at the exact same time, without observing others' concurrent choices. The final outcomes depend entirely on the combined effect of all these simultaneous, independent decisions. A classic example is two companies deciding whether to simultaneously enter a new market segment. Then, we explore sequential and repeated games, where timing and future interactions are key. In sequential games, players make decisions one after another, with later players observing earlier actions. Repeated games involve multiple interactions, allowing for strategy development and potential cooperation over time. Consider a large firm investing, and then a smaller firm decides whether to follow based on that initial move. Today, we'll explore how to effectively represent game outcomes, a fundamental aspect of understanding strategic interactions in business. We will delve into key mathematical tools from game theory, which are essential for analyzing complex decision-making scenarios. First, let's look at the payoff matrix, a crucial tool for visualizing the results of strategic choices. This matrix, a 2x2 grid, illustrates the combined payoffs for player A and player B based on their chosen strategies. Here, a 1 and a 2 represent the distinct strategies available for player A to choose from. Similarly, B1 and B2 denote the different strategies that player B can employ in this game. The term AX by shows the specific payoff for player A and player B when a select strategy AX and B chooses strategy BY. Think of the payoff matrix as a powerful way to visualize all potential strategic outcomes in a game. This matrix comprehensively displays all possible strategy combinations and their corresponding payoffs for each player, crucial for analysis. Next, we have the concept of best response, which guides a player's optimal strategic choices. This formula helps us find player A's best strategy, which maximizes their payoff, given the opponent's moves. The term argmax means we are looking for the argument or strategy that yields the maximum possible value. A's strategies refers to the complete set of all possible actions or choices that player A can make. And payoff to A simply represents the numerical outcome or benefit player A receives from a specific action. The best response concept helps us identify a player's optimal strategy, considering what others might do. This concept identifies the optimal strategy for a player, assuming the other player's strategies are fixed, crucial for Nash equilibrium. Now, let's shift our focus to the diverse approaches businesses use for product pricing, a key strategic decision. Effective pricing requires balancing production costs, the perceived value to customers, and the competitive landscape. First, we have cost-based pricing, a straightforward approach to setting your product's price. Here, The price is determined by adding a specific markup percentage directly to the total cost of production. Next, consider value-based pricing, which focuses on the customer's perspective of your product. In this method, the price is set based on the perceived value of the product to the customer, not just its cost. Another common strategy is competition-based pricing, where market dynamics heavily influence your decisions. With this approach, prices are set mainly in direct response to how competitors are pricing their similar products. Penetration pricing is a strategy used to quickly gain a foothold in a new or existing market. This involves setting low initial prices to rapidly gain market share and attract a large customer base quickly. Finally, we have skimming pricing, often used for innovative new products entering the market. This strategy starts with high initial prices for new products, which are then gradually lowered over time. Let's now explore the various factors that significantly influence a company's crucial pricing decisions. Market demand is a critical factor, as it dictates how much customers are willing to pay for your product. Understanding your cost structure is essential, as it directly impacts your profit margins and pricing flexibility. The competitive landscape plays a huge role. You must consider what your rivals are charging for similar products. Your brand positioning also matters, as a premium brand can often command higher prices than others. The regulatory environment, including laws and policies, can also significantly impact how you set your prices. Finally, your overall pricing strategy itself is a major factor, guiding all these individual decisions. We'll now explore how to quantify pricing decisions, which is crucial for maximizing revenue and understanding market dynamics. Let's dive into the essential calculations that will help us make truly effective and data-driven pricing choices. First, we'll look at the markup percentage, a fundamental calculation for understanding how much profit you're adding to your costs. The markup percentage is calculated as the selling price minus the cost price, divided by the cost price, all multiplied by 100. Here, the selling price is simply the price at which your product is ultimately sold to the customer, and the cost price represents the total cost incurred to produce or acquire that specific product. This formula is essential for calculating your profit margin, ensuring you're setting prices that generate sufficient revenue. It directly shows the percentage added to your cost price to reach the selling price, which is vital for securing your profit. Next, let's understand the break-even price, a critical concept for knowing the minimum price needed to cover all your expenses. The break-even price is calculated by dividing fixed costs by unit sales volume, then adding the variable cost per unit. Fixed costs are those expenses, like rent, that remain constant regardless of your production volume. The unit sales volume refers to the total number of individual products or services that you manage to sell. Variable cost per unit is the expense directly tied to producing each single unit, changing with your output. This formula helps you identify the price point where you cover all your costs, without making any profit or loss. It's the exact price where all fixed and variable costs are covered, meaning your business breaks even. Finally, we'll examine price elasticity of demand, which helps us understand how sensitive customer demand is to price changes. Price elasticity of demand is the percentage change in quantity demanded divided by the percentage change in price. The percentage change in quantity demanded shows how much the amount consumers want changes, and the percentage change in price is simply how much the product's price has shifted. This metric is key to understanding how sensitive your customers are to price adjustments, guiding your pricing strategy. It measures how much the quantity demanded responds to price changes, revealing if your product is a necessity or a luxury. Now, let's shift our focus to evaluating investment projects, a crucial step for making smart capital allocation decisions. We'll explore systematic approaches and various tools that help us effectively allocate capital for future growth. One key tool is net present value, or NPV, which helps us assess the profitability of potential investments. Another vital metric is the internal rate of return, or IRR, indicating the project's inherent rate of return. The payback period is also important, showing how quickly an investment will generate enough cash to cover its initial cost. We also use the Profitability Index, or PI, to compare the present value of future cash flows to the initial investment. Finally, the Modified Internal Rate of Return, or MIRR, offers a more reliable rate of return for comparing projects. Let's quantify investment value by exploring specific formulas that assess project profitability and associated risks. These formulas are vital tools for accurately assessing a project's potential profitability and managing its inherent risks. Our first formula is Net Present Value, or NPV, a core method for evaluating the profitability of an investment. NPV is the sum of cash inflows at time t divided by 1 plus the discount rate r raised to the power t minus the initial cost. Here, C sub t represents the cash inflow that you receive during a specific period t. The r denotes the discount rate, which is essentially your cost of capital or required rate of return. And C sub 0 represents the initial investment cost, the money you put in at the very beginning. This formula is crucial for measuring a project's overall profitability, helping you decide if it's a worthwhile investment. NPV calculates the difference between the present value of cash inflows and outflows, showing the investment's net gain or loss. Next, we have the Internal Rate of Return, or IRR, a powerful metric to understand a project's expected return. For IRR, we set 0 equal to the sum of cash inflows at time t divided by 1 plus IRR raised to t minus the initial cost. Again, C sub t stands for the cash inflow generated during a particular period t of the project. IRR itself is the unique discount rate that makes the net present value of the project exactly 0. And C sub 0, as before, is your initial investment cost, the capital outlay at the start. This formula helps identify a project's break-even return, indicating the maximum cost of capital it can sustain. IRR is the discount rate where the NPV of all project cash flows becomes 0, showing its inherent rate of return. Lastly, let's discuss the payback period, a straightforward measure of how quickly an investment recovers its initial cost. The payback period is calculated by dividing your initial investment by the annual cash inflow generated by the project. Initial investment refers to the original capital outlay, the total amount of money you first put into the project. Annual cash inflow is the consistent amount of cash that your project generates each and every year. This metric quickly shows you the exact time it will take to recover your initial investment from project earnings. It directly tells you how fast an investment's initial cost is recouped by the cash flows it generates. All right, let's wrap things up with a quick summary of our key discussions today, bringing everything together. These are the essential takeaways, crucial points you'll want to remember for your future projects. Remember, game theory provides a powerful framework for strategic interactions, helping us anticipate competitor actions. Nash equilibrium describes stable states where no player benefits from changing their strategy unilaterally. Pricing strategies require balancing costs, customer value, and market competition to achieve optimal revenue. Common approaches include cost-based, value-based, and competition-based pricing, each with distinct benefits. Capital budgeting evaluates long-term investments using techniques such as net present value and internal rate of return. Effective investment decisions are crucial for ensuring long-term growth and ultimately maximizing owner wealth.